Interest. It's a fundamental concept in the world of finance, a force that shapes our financial lives in profound ways. For some, it's a powerful engine, diligently helping them build wealth and achieve their financial dreams. It's the magic behind compound growth, turning small savings into substantial fortunes over time. But for others, interest can be a relentless trap, ensnaring them in a cycle of debt that seems impossible to escape. High interest rates on loans and credit cards can quickly turn manageable debts into overwhelming burdens. It's a double-edged sword, a financial tool that, when wielded correctly, can propel you towards prosperity. But if you're not careful, it can cut the other way, hindering your progress and creating significant financial stress. When you borrow money, whether it's for a car, a house, or everyday expenses, you pay interest on that loan. Conversely, when you save money in a bank account or invest in the stock market, you have the potential to earn interest or returns on your investment. The very same principle that allows your savings to grow exponentially can also cause your debts to balloon out of control if left unchecked. Therefore, your primary financial objective should be to position yourself on the advantageous side of interest as much as possible, maximizing your earnings while minimizing your expenses. Remember, interest isn't just an abstract mathematical concept confined to textbooks and spreadsheets. It's a critical factor that directly influences your ability to achieve your long-term financial goals, from buying a home to retiring comfortably. So, let's embark on this journey together and unlock the secrets to mastering interest. Let's start with the basics. Interest is the cost of borrowing money, or the reward for saving it. When you borrow from a bank, you pay extra money back. When you save or invest, you can earn extra money over time. So interest is money you pay when you borrow, like with credit cards, car loans, or a mortgage. But it's also money you earn when you save in a bank account or invest for the future. Here's the catch. Interest can work for you, or against you. High-interest debt, like credit cards, grows fast and can be hard to escape. If you only make minimum payments, your balance barely shrinks as interest piles up. On the flip side, saving and investing lets compound interest grow your money, even while you sleep. The earlier you start, the more powerful compounding becomes. The key is to pay off high-interest debt quickly, and start saving or investing as soon as you can. Even small amounts add up over time. Make interest your friend, not your enemy. Remember, understanding how interest works helps you make smarter choices with your money. Take control and let your financial future grow. Now that you know what interest is, let's look at what actually affects the interest rates you see. Let's break them down one by one. First, the loan amount. The more money you borrow, the more risk the lender takes. Sometimes, bigger loans come with higher rates, but not always. It often depends on the type of loan and your overall financial situation. Next, the loan type. Different loans have different rates. For example, credit cards usually have higher rates than home or car loans. That's because credit cards are unsecured. They don't have anything backing them up, so lenders charge more to cover their risk. Then, there's tenure, or how long you take to pay back the loan. Short-term loans often have lower rates, while long-term loans might cost more over time, even if the annual rate is lower. The longer you borrow, the more interest you might end up paying. Inflation is another big factor. Inflation means prices are going up over time. When inflation rises, interest rates usually go up too, so lenders don't lose money as the value of cash changes. Your credit history also matters a lot. If you have a good history of paying back what you owe, lenders trust you more, and you can get lower rates. If your credit score is low, you might pay higher interest because the lender sees you as a bigger risk. Finally, there's the risk of default. This means the chance that a borrower won't pay the money back. The riskier the loan, the higher the interest rate to make up for possible losses. So, whenever you see an interest rate, remember, there's more going on behind the scenes than just a number. Understanding these factors can help you make smarter choices, whether you're borrowing or saving. Let's talk about simple and compound interest. When it comes to understanding how your money can grow, it's essential to grasp the concept of interest. There are two main types of interest that you'll encounter in the financial world: simple and compound. Simple interest is calculated only on your original amount, also known as the principal. It's a straightforward way to earn returns on your savings or investments. Steady, predictable, but slow. It offers a consistent return, but it doesn't take advantage of the power of reinvestment. For example, $1,000 at 5% simple interest earns you $50 a year, every year. The interest remains constant, providing a reliable but modest return. Compound interest is where things get exciting. This is where your money truly starts to work for you. Here you earn interest on your original amount, plus all the interest you've already earned. This is the key difference between simple and compound interest. That means your money grows faster and faster over time. It's like a snowball rolling downhill, gathering more snow and momentum as it goes. $1,000 at 5% compound interest becomes $1,050 after 1 year, then $1,102.50 the next, and so on. The interest earned in the first year now contributes to the principal in the second year, leading to even greater returns. The difference may seem small at first, but over decades, compounding can turn small savings into real wealth. The longer your money compounds, the more significant the impact becomes. This is the secret weapon of smart savers and investors. Understanding and utilizing compound interest is crucial for long-term financial success. The earlier you start, the more powerful compounding becomes. Time is your greatest ally when it comes to harnessing the benefits of compound interest. Let your money work for you. Embrace the power of compounding and watch your wealth grow exponentially over time. Let's talk about taking control of your financial future. Interest is a powerful tool, use it wisely, and it can help you achieve your goals. Cut down high-interest debt. Every dollar paid off is money you keep. Start saving and investing even if it's just a little at first. Set up automatic transfers to build your savings effortlessly. Don't try to do everything at once. Small, consistent steps add up. Check your interest rates, make an extra payment, or talk to your family about money. You're in charge of your financial future. Use what you've learned to make interest work for you. The best time to start is now. Subscribe for more tips on how to build a stronger financial future. See you in the next video.